Budgets in the past have had a magical impact on stock markets. Remember the 1991 budget and then the 1997 dream budget? Lately, budget announcements are more incremental, but the cocktail of fiscal deficit plus tax changes plus capital expenditure can still bring out the bulls or scare them. So what are the key numbers or items to watch out for this year? First, the market, and more particularly India Inc., may not want to hear a very high fiscal deficit or market borrowing number. Our CNBC-TV18 poll says the average expectation is that fiscal deficit will be brought down to 5.8% from 6.4% in the current year FY23. This will mean the government will borrow a net, say, 11.5 trillion rupees from the market, plus a 5 to 5.2 trillion rupees borrowing by the state governments. The markets can stomach a 6.7 trillion borrowing number or thereabouts. Next, what are the GDP growth and tax assumptions? Nominal GDP. Here a CNBC-TV18 poll says a 10% nominal GDP growth and an 11% growth in taxes will be seen as fair. Remember, FY23's 15.5% nominal GDP growth and tax growth that was even higher can't be the base case for FY24. Next, the market may want to hear about capital expenditure. A 15% growth in capex to about rupees 8.7 trillion rupees is what the market is expecting. Last year, it was a big 25% growth in capex. Finally, the black box. Will there be any rationalization of capital gains tax on equities? Will short term be redefined, extended to 2 or 3 years? Will the tax rate on short term capital gains for equities be increased? Those are the fears according to our poll. But let me defer to our experts. I have with me the best of market watchers, veterans, Hiren Ved of Alchemy Capital and Nilesh Shah of Kotak Mahindra AMC. Gentlemen, thank you very much for your patience and for attending to our pre-budget What Market Wants show. Hiren, first to you. And I have to ask you this troubling question first. If the short-term capital gains are going to be altered, extended term or percentage, will that be a big negative?
So Lata, Happy New Year to you, first of all. And yeah, I think what is most current in the minds of the investors is the noises around the potential changes in capital gains. Now, my view is that if they change the tenure of what constitutes short-term capital gains tax, I think that will be merrily stomached by the market, because by and large, people are long-term investors, and the difference between the short and the long-term rates is not very significant at this stage. What the markets may not like, or investors may not like, is there is a hike in the rate of taxes. And I think that is very important, not only from a domestic investor perspective, but I think it will also send a signal to the international investor community that you just changed the tax rates in 2018. And it would be important if you kept the tax regime fairly stable. So if we want to attract foreign capital, which we do want to, and we don't want to disturb the capital markets, then I think a rate change is something which is probably will be problematic. A tenure change will not be.
Okay, got that. Nilesh, similar question to you. In a previous occasion, you told us that a lot of gimmicks that are going on around capital gains, trying to disguise or dodge them, will be definitely, attended to. But this is a more direct question which affects everyone. Do you think that an extension of the tenure term of short-term capital gains or an increase in the amount will be received badly?
I think extension of tenure is logical. Today, there is 1 year for equity, 2 years for real estate, 3 years for debt. Any investor will say that 1 year equity is not long-term. So making it 3-year across the board will be fine. But we should not increase the tax rates. We should plug the loopholes around capital gains. Zero coupon listed debentures convert interest income into capital gains. 1 lakh crore is the outstanding amount. Assuming 10% interest rate and 25% tax arbitrage, that's collection of 2,500 crore. SME exchange IPOs are clearly, capital gains tax planning. Again, it's converting black income into long-term capital gains. If we plug that, that will result into further savings. Today, STT on cash delivery and FNO is the same. Some tinkering there, which will discourage speculative activity in FNO, again will result into higher income and will be good for the market. ULIP inter-scheme transfers are not taxed. 6 lakh crore AUM, assuming 30% switches, 1,80,000 crore. Assuming 20% tax arbitrage, that's again 3,600 crore for to be taken. So let's plug the loopholes on market-linked zero coupon listed debentures, ULIP interchanges, SME exchange capital gains tax planning, and such kind of things. Then there will be no need to raise capital gains tax rates.
Okay. You're not just a good investor, you're also a very good tax expert, I must say, Nilesh. Hiren,
blood of chartered accountants is still there in the system.
Yeah, absolutely, I agree. Hiren, we do worry a lot about the extent of taxes. Like both of you point out, if this 15% becomes 20 or 25, it'll be taken badly. When long-term capital gains tax was first introduced in equities, before that, the market, was very worried. But we took it in our stride and the market did very well thereafter. So even if there is some negativity on the rate, do you think it'll be a passing blip? After all, it's the growth story that will matter, no?
No, Lata, I understand, because the markets are a mechanism which have the ability to discount both good and bad news, right? So I don't think it is about the fact that, we will keep brooding over it for a long period of time. I think, yes, whatever reaction has to happen will happen, and then people will move on, right? But I think what I meant to say was that, what is the need? I mean, we need a certain stable tax regime. We've just done a change in 2018. It was not too far back.
Yes.
And I think it's more a signaling rather than the actual increase or decrease in rates, which is important.
Fair point. Yep. No, actually, we've not heard too many big numbers even on that long-term capital gains. So probably it was not such a big income earner. And therefore, perhaps tinkering is not called for. But I'll move to the next other big number. What's the next big number you'll watch out for? Is deficit very key, Hiren?
Yeah, I mean, I think the deficit number is important, but everybody understands that there will be a glide path to fiscal consolidation. I think during COVID, it was okay to run large fiscal deficits. But now, I think if we want macroeconomic stability, and if we want the currency to be stable and interest rates to be stable, then we have to have the ability to show that we are on the glide path of reducing fiscal deficits, because deficits are never, it's good for a year, but the hangover is very, very bad.
Yes.
And I think what you have put out in your expectations is pretty much where everybody is in terms of the fiscal deficit. I think what was most credible was that, during the COVID years, we decided to bring all the off-balance sheet items onto the balance sheet.
Yes.
So that number became very credible. There were no whispers and murmurs about how much is shoved under the carpet. And I think there is a certain credibility that has been brought to the fiscal deficit management. And I think that should continue. And whether it reduces by a couple of basis points more or less, but I think the glide path is very clear. It's somewhere in the range where you have indicated.
Okay. Just to finish that point, Nilesh, would you say a GDP and a tax assumption between 10 and 11% for tax growth is something the market would watch very closely? I mean, this government has not shown a penchant for outlandish assumptions. But, we did do, I think FY23 is going to end with some big 18% rise in taxes. So do you think a high tax assumption will disturb the market?
So markets will be first looking at where the spending is occurring.
Okay.
Even if the fiscal deficit is higher than 5.8%, but it is for infrastructure investment, then it can be tolerated. Even if fiscal deficit is higher than 5.8%, but along with infrastructure allocation, there is a guide path to the lower path of the fiscal deficit, then again it can be tolerated. Similarly, on the taxation side, if you're plugging the loopholes, and there are so many which we can talk about, then higher tax collection can be assumed.
Yeah.
But if you're not going to plug the loopholes, then it's better to be conservative than aggressive.
Okay.
In fact, the
Fair
best
enough.
thing to do is, like ethical hacking, let's create ethical tax loophole plugging competition. There are many chartered accountants who will be more than happy to contribute towards improvement of income tax laws. They know where the hacking is possible. They'll give you solutions how to bridge it. And voila, the tax to GDP ratio will improve, will move from African nations to Asian nations in terms of tax compliance.
Excellent. Nilesh, you're much more than just a tax and a market expert. This is a genuinely great strategist. Yes, let's have a tax hackathon race. But you correctly started by saying, where is the money going to be spent? I'll do one thing. I'll take a very quick break and let's concentrate on the expenditure side and what the market wants. Back in a minute.